So Tony, we're looking at your fund tonight. It is the Vunani Fund Managers CPI plus 5% fund. And just taking a look at the managers, Tony Bell, you're one of them, and Guy Fletcher. The fund size, 133.8 million rand. Objective there, CPI plus 5%, and of course the management fee coming in at a 1.25% level. Tony, talk to us about the asset allocation strategy you've got right now and the environment as you see it. You've talked about the new norm.
At the moment, how we're positioned in the fund is we're slightly defensive. A normal asset allocation for this fund at the sort of strategic level would be around 55% in equities. We've got about 10% of that hedged at the moment. The markets are very choppy and noisy. The Dow's had, the S&P's had a little bit of a setback in the last few weeks, and I think we're just going through the period of indigestion where issues like the fiscal cliff are being debated and working themselves through. From an underlying perspective, we still see good value in many of the stock picks in the portfolio. And what we're looking for there in this low interest rate environment is we're looking for companies that can innovate, that can maintain their earnings power, where free cash flow is strong and where companies can generate a good return on the capital that they use, that they get from shareholders in order to create shareholder value. So at the broad-based asset allocation level, we're slightly underweight equities. In terms of nominal bonds versus inflation-linked bonds, we've had a high preference for a while in the inflation-linked bond area. We recognize, as Roland said, that there are a lot of cost push factors in terms of domestic inflation, where even the Reserve Bank governor is now starting to sound a little bit more concerned about the prospect for higher inflation. Food prices coming through, additional energy prices coming through, some inefficiencies coming through in the labour market, some higher wage pressures coming through in the labour market. So our bond exposure is very short duration. In other words, we have a shorter term maturity relative to the all bond index, and we're looking for a strong yield pickup from being in bonds that have got a higher yield than government bonds.
Let's maybe have a look at some returns here, because I think that's important. Just have a look at the table on your screen, and you'll see the returns for the Vunani CPI 5% fund. And you can have a look there, 12, 24, and 36 months. And you can see it beating CPI plus 5, obviously, and keeping that the fund squarely above inflation and its growth objective of 5%. I mean, Tony, maybe just a question quickly. How do you know when you're shifting from one regime to the next one, and in what regime are we at the moment? Is it normal or is it good state? And maybe I'm even wrong there.
Where interest rates are being kept artificially low and central banks are already taking over the role that government should normally fulfill, we see this as a very slow grind for. And the asset manager is somewhat challenged, because whilst we've had really good returns from equities over the last 3 years, those have largely been driven by big liquidity pushes from central banks. What we see going forward is that central banks themselves can't push forever. You can't push on this piece of string for a long time. The Fed, for example, is already sitting with a leverage ratio of around 55 to 1. Normally it wouldn't even run close to 20 to 1. So we're very cognizant of the fact that the central banks are largely all in. And so what we're looking for in terms of managing the portfolio is to be very, very alive to the possibility of asset class risk and building an additional margin of safety in the stocks that we pick and the bonds we put into the portfolio. To get to a good state, a great deal better news would have to come through from the underlying real economy, and central banks would have to start to move to a more moderate position in terms of their balance sheets.
Tony, if you looked at your cumulative performance, it's been above the CPI plus 5 target range, but do you spend a lot of time within the asset classes, or is it all purely, let's call it asset allocation that's driving the performance, or do you do stock picking and bond picking as well?
Yes. Roland, nice question. I think from an asset allocation perspective, the simple answer is you've got to get the big number right. If, for example, we were to go to a bad state in this fund, we would move the asset allocation on equities from around 55 down to as low as 28, and we'd have a very defensive bias in the portfolio. At the moment, as indicated, we're around 50. What I spend most of my time looking at is in fact the stock picking which we do bottom up. We run very detailed free cash flow models on each of the 120 stocks that we follow. We visit with companies. We do old style traditional stock picking, old style traditional bond picking. And in this fund, if I have a look at the returns that have been achieved, a large portion of those returns have come from very good stock picking in the portfolio, where companies like Woolworths, Truworths, and the like have done exceptionally well, Richmond, etc.
Yeah.
And those have added substantially to the portfolio over the last 1, 2, and 3 years.
Well, Tony,
That's a combination.